Hello, ladies and gentlemen, participant of Asian Scholars Network International Conference. May God bless you all. Firstly, kindly let me introduce myself. I am Muhammad Raihan, a Master of Management student at University of Indonesia. At this point opportunity, please let me present and share to you about my research result. The title of the research is Analysis of Financial Transfer Pricing Aspect on Intercompany Loan Transactions. Without further ado, let's begin with the background. So the globalization and the control of the supply chain by multinational companies are factors that encourage attention to the transfer pricing issues. The portion of the transaction that occur around the world is dominated by related party transactions, which can be estimated to have the contributions around 60% to 80% of the total transactions. And then the results of the World Investment Report 2020, which is published by the United Nations Conference on Trade and Development, show that Indonesia ranks 18 as the host country that receives foreign direct investment. The trend of multinational companies is growing rapidly, both in Indonesia and in the world. The rapid growth of foreign direct investment and the development of multinational companies in the last decade reflect the enormous economic activities occurring in a country. So the transactions that occur generally involve more complex products and services which are very difficult to pricing. Transactions carried out by multinational companies can range from simple transfer of goods to intercompany transactions involving intellectual property, financial instruments, management services, and so on. With the growth in economic activity, the state has the sovereignty to impose tax on income arising from transactions activities carried out by multinational companies. In this case, the tax authority has a responsibility to ensure that transactions carried out by multinational companies which have a special relationship, or we can call it as related party transactions, must meet with the provision regarding the arm's length principle. One of the growing issues in the area of transfer pricing is related to the existence of financial transactions between the parent company and its subsidiary company. Therefore, companies must also be able to design a financial transaction scheme for fixing their transfer price so that they are not disputed by the tax authorities in the future. Government institutions, especially tax authorities, claim that the issues of transfer pricing is one of the causes of the potential loss of tax revenue that can be obtained for multinational companies. Due to the dynamic regulations, companies are encouraged to always comply with formal regulations. This pressure motivates multinational companies to design the transfer pricing strategy in such a way that it doesn't violate tax regulations. Based on the argument, the research questions, basically there are two research questions. The first one is how is the arm's length principle applied to the intercompany loan transaction scheme? The second one is how is the transfer pricing method applied in determining the fair price related to the intercompany loan transaction scheme? And the objective to describe and analyze the application of the arm's length principle on the intercompany loan transaction. So based on the previous argument, the current study aims to examine the application of arm's length principle for an intercompany loan transaction that is often carried out by multinational companies to finance or funds projects carried out by companies that are members of the group. So the researcher took a foreign investment company as a case study to describe real cases that occur in Indonesian company, and also as a tool in understanding both of the concept related to the capital structuring of a company through a loan scheme and the application of the arm's length principle. Next, there are five theories that being used in this research. The first one is tax management, and then transfer pricing, and then international tax, tax avoidance practice, and the last one is anti-tax avoidance rules. This is the preceding research. So related to the research method, so this research use a qualitative approach with a descriptive research design. A case study research is being used and being adopted in order to seek an understanding concerning the application of the arm's length principle, especially for the financial transaction within a multinational company. This case study research was conducted at a multinational company which reside in Indonesia. And also data collection will be carried out through in-depth interview with the relevant informants, and also through literature review. So we can jump to the discussion. Before analyzing the application of the arm's length principle to intercompany loan transaction, it is necessary to describe the case background and business background of the investigated company. So the company is a private company domiciled in Indonesia, which is engaged in electricity production, which will be distributed or sold to a power company domiciled in Indonesia as well. So the company has a plan to build a power plant in order to produce high capacity electricity. The total estimated project value for the construction of the power plant is around 46 trillion Indonesian rupiah. Funding for the company's project is basically carried out by creditors with consideration of the creditworthiness of the project being undertaken. In the scheme, the company obtains funding from international banks, which are the creditors of senior debt. In addition, the company also receives funding in the form of loans obtained from its shareholders. The amount of funding in the form of loans provided by shareholders is based on the proportional amount of each share ownership in the company. For the loan principal obtained from an independent party amounting to 595 million USD, the company is required to pay interest on the terms of LIBOR plus a margin of between 2.4% to 3.5% per year. In addition, the time period or tenor is determined for 18 years using a floating rate scheme. On the other hand, funding in the form of loans obtained from the shareholders was 130 million USD, with an obligation to make interest payments of 11% and was fixed rate with a tenor of 20 years. And next, in analyzing transfer pricing in intercompany loan transaction, it is necessary to analyze the loan needs and economic benefits before we are determining the fairness of the loan interest rate charged by the lenders. Based on the company's cash position, without loan from related party, it can be known that the final cash balance held by the company is in a negative position. In analyzing the company's funding needs, we can see whether a company needs money to carry out the operational activities. If the company cash position is in negative position before the provision of loan from related party, then the loan obtained from the related party is needed by the company, and the loan is not solely used as an instrument of tax avoidance through the loan interest charging scheme. In addition, when we viewed from the aspect of economic benefits, based on the information and data obtained from in-depth interview with the company management, it can be analyzed that loan funds originating from affiliated parties provide economic benefits that help the success of the construction of a power plant project. Namely, the construction project survive, the company can build high capacity power plants, and then the company can acquire the latest technology, and the last one is the company can reduce the risk of air pollution through the technology. So based on the analysis of the need for funds and the economic benefits received by the company, it can be concluded that the loan obtained from the related party are really needed in maintaining the continuity of the power plant construction project. So before determining the fairness of the interest payment, we have to conduct a comparative analysis of the transaction conducted by the company and its related party. The application of arm's length principle is generally based on a comparison of the conditions of the transaction between related parties with comparable conditions for the transaction that occur or carry out between unrelated parties or independent parties. To realize the comparability analysis, factors that have an economic value from the transaction being compared must have a sufficient or high level of comparability. To apply the arm's length principle, the comparison of loan transaction made by the company with senior lenders, or we can call as internal data comparable, must be further and in detail analyzed to justify whether the available internal data can be used as a reliable comparative data. So there are 6 major aspects which are compared, namely creditor business objective, source of fund, type of loan, interest rate, seniority of loan, availability of debt collateral, and the last one is the payment priority. So based on the comparability analysis, a conclusion can be drawn that the loan transactions or the loan interest payment made by the company with senior lenders, or we can call as internal comparable data, have material differences that can affect the price or profit generated. For differences in condition as stated in the table, reliable adjustment cannot be made to increase the level of comparability. So in order to apply arm's length price to loan interest transactions conducted by the company with its related party, external comparable data that can be obtained from commercial database will be used. The use of commercial database as an external comparable data is also recommended by the OECD transfer pricing guidelines. So, based on the OECD transfer pricing guidelines regarding the selection of transfer pricing methods, it is necessary to pay attention to several conditions that make the selected method can produce high reliability. From the several available methods, the researcher tries to dissect these methods one by one until the method that is most suitable for the type of transactions carried out by the company and its related party. The following table describes the selection of the most appropriate transfer pricing method for interest paid to the related party. So, from the table we can decide that CAP is the accepted method. It is because the CAP method is the most appropriate method to test the fairness of the loan interest transaction made between affiliates. The reasons that reinforce this are because this method can provide direct comparisons of the fairness of the tested transaction and the transaction from the independent comparators. Also, this method recommended by the OECD transfer pricing guidelines and also by Indonesian income tax law. So, if the method of determining of the transfer price has been determined, the next step in analyzing the fairness of interest rate carried out by the company and its related party is to look for the external comparable data through commercial database that can provide financial data and information related to interest rates given between independent parties. In this research, in this stage of external comparables, there are 11 comparable data that had a high level of comparability were found. So, based on the results of the fairness analyzing using the CAP method on the loan interest payment paid by the company to its related party, the result of the arm's length range are 9.63% to 13.75%. Meanwhile, the loan interest rate transaction paid by the company to its related party is 11%. So it can be concluded that the transaction of the loan interest paid can be said to have met the arm's length principle. So that's all for my presentations. Thank you very much for your kind attention. Stay safe, stay healthy, and also have a good day. Thank you.